If you're watching the markets right now, you are witnessing something that goes far beyond a standard trading session. You are witnessing the absolute collapse of a decades-long financial illusion, brought down not by economic data, not by inflation reports, but by the terrifying reality of geopolitics. On Friday morning, the bullion banks woke up in a cold sweat. They looked at the newswire. They looked at the naval deployments. They looked at the calendar. And they suddenly realized that the most dangerous radioactive trade in the entire global financial system right now is being short physical metals heading into this weekend. Ladies and gentlemen, Asian guy here, you have to understand the mechanics of weekend risk to understand the panic we saw on Friday. When you are a massive Wall Street bank holding billions of dollars in naked short positions on gold and silver, you are playing a game of musical chairs. As long as the music is playing, as long as the markets are open, you can trade your way out of trouble. You can spoof the market, you can dump paper contracts, you can manage your margins. But when the bell rings on Friday afternoon, the music stops. The markets freeze for 48 hours. You're locked in a room with your position, and if you are short gold and a war starts on Saturday night, when the markets reopen on Sunday evening in Asia, you do not just take a loss, you are instantly bankrupted. You are wiped out by a gap up in price that triggers every margin call in your portfolio simultaneously. And this weekend, the risk of that war starting is higher than it has been in our lifetimes. The catalyst is no longer a rumor. It is being priced in as an imminent reality, a direct kinetic U.S. military attack on Iran. We are watching the largest mobilization of naval firepower in the Middle East in decades. Carrier strike groups are in position. The rhetoric has crossed the Rubicon from diplomatic posturing to operational readiness. But the banks aren't just terrified of a localized strike. They are terrified of the geography. Look at the map. Look at the Strait of Hormuz. It is a narrow ribbon of water, barely 21 miles wide at its choke point. Through that tiny sliver of ocean flows roughly 20% of the world's daily oil consumption. We are talking about 20 million barrels of crude oil and liquefied natural gas passing under the crosshairs of Iranian shore batteries every single day. If the U.S. strikes, the immediate asymmetric response from Tehran will be to mine that water, target the tankers, and shut the strait down. If that happens, the global energy supply chain has a heart attack. Oil does not just drift higher, it violently spikes to levels that will instantly shatter the Western economy. We are looking at a scenario where shipping insurance goes to infinity, the flow of energy stops, and the inflation we have seen over the last few years looks like a warm-up act. But the nightmare for the financial system goes even deeper. This is not 2003. This is not a unipolar world where the U.S. military can act without systemic blowback. Iran is a newly minted member of the BRICS alliance. They are deeply integrated with the strategic architectures of both Russia and China. Traders on Wall Street and in the City of London are whispering a phrase that should chill you to the bone, the Archduke Ferdinand moment. In 1914, the assassination of one man triggered a web of alliances that dragged the entire planet into a world war. Today, an attack on Iranian infrastructure risks dragging Moscow and Beijing into the fray to defend their strategic partner and secure their own energy lifelines. If China and Russia are forced to respond, we are no longer talking about a regional skirmish. We are talking about the opening salvo of World War III. When you inject this level of existential, systemic fear into the global financial markets, the rules change instantly. The paper suppression trade, the algorithmic game of dumping futures contracts to scare retail investors out of their positions, is completely obliterated. You cannot stop a hypersonic missile with a COMEX short contract. You cannot secure an oil tanker with a paper derivative. When the survival of the fiat currency system is called into question by the threat of global war, institutions do not want paper. They want physical weight. They want atoms. They want the only money that has survived every war, every empire, and every collapse in human history. This realization is what sparked the absolute frenzy on Friday morning. The shorts scrambled for the exits. They hit the buy button to cover their positions, regardless of the price. The algorithms that were programmed to sell the rips suddenly reversed course and started buying the panic. And the result was an explosion in the price of safe haven assets that broke the charts. We saw gold go completely vertical, slicing through major psychological resistance levels like a hot knife through butter. It didn't just retest the highs, it went airborne. We need to talk about exactly what happened at 09:45 New York time. We need to talk about the breach of $5,100. You want to know what total unadulterated institutional panic looks like? You do not look at the stock market. You do not look at the bond market. You do not even look at the price of oil. You look at the one asset that has served as the ultimate barometer of human fear for 5,000 years. You look at gold. And on Friday morning, gold did not just rally. It did not just tick higher on a geopolitical headline. It went completely, violently vertical. We need to dissect exactly what happened on the tape, minute by minute. Because the price action we just witnessed is the ultimate confirmation that the smart money is preparing for a systemic shock. For weeks, the mainstream financial press has been telling you that the precious metals rally was over. They told you that gold was consolidating, that the momentum was broken, and that the top was in. They drew their little technical analysis triangles and told you that the resistance at $5,050 was an impenetrable ceiling. They told you the banks had the price perfectly capped. But technical analysis is completely useless when the missiles are being loaded onto the launch pads. At exactly 09:45 New York time, the dam broke. The initial reports of the U.S. naval repositioning hit the institutional terminals. The algorithms that scanned for geopolitical threat keywords triggered simultaneously. And the buying that followed was not from retail investors logging into their brokerage apps. It was from sovereign wealth funds, central banks, and massive institutional family offices making split-second decisions to dump their fiat exposure. In a matter of minutes, gold sliced straight through that impenetrable $5,150 resistance, like it was not even there. There was no pullback. There was no consolidation. The bid stack just kept refreshing higher and higher. The short sellers who had confidently parked their limit orders at the resistance line were instantly vaporized. Their margin calls triggered automatic buy-to-cover orders, throwing literal gasoline on an already raging fire. By the time the dust settled from that initial morning shockwave, gold had powerfully retaken the $5,100 level. $5,100 reclaimed in a single session. This is not normal market behavior. This is what happens when the people who run the world realize that the currency they print is about to lose its primary backing. The illusion of global peace and unipolar military dominance. They are selling their paper promises, and they are demanding the only asset that carries zero counterparty risk. Let me be absolutely clear about what this Friday session means for your portfolio. The correction is over. The consolidation phase is dead. The bottom is officially, unequivocally in. The banks tried to shake you out over the last few weeks with their coordinated smashdowns, hoping you would surrender your physical position before the geopolitical reality set in. If you held the line, you just won the game. Because the momentum we are seeing right now is not going to stop at $5,100. The velocity of this move, driven by the existential threat of a Middle Eastern conflict dragging in major superpowers, dictates that the previous peaks are no longer resistance levels. They are magnets. A violent retest of the $5,600 all-time high is now imminent. And frankly, in a scenario where the Strait of Hormuz is compromised, $5,600 will look incredibly cheap in the rearview mirror. We are entering the phase of price discovery where the fiat denominations become meaningless, and the only metric that matters is how many ounces of physical weight you hold in your possession. But while gold was busy breaking the sound barrier, an entirely different, even more dramatic war was being fought in the silver pits. The bullion banks knew they were losing control, so they tried to use a massive breaking news event out of Washington, D.C. to manufacture a crash. They set a trap, and it failed spectacularly. We need to talk about the Supreme Court. We need to talk about the algorithm slam and the ferocious $4 reversal that just burned the silver shorts to the ground. While gold was dominating the headlines by retaking the $5,100 level, an entirely different kind of warfare was taking place in the silver market. We need to talk about what happened in Washington, D.C. on Friday morning, and how the bullion banks tried to weaponize the United States Supreme Court to save their short positions. If you want to see exactly how algorithmic market manipulation works in real time, look no further than the SCOTUS slam that occurred yesterday. Here's the setup. On Friday, the Supreme Court handed down a massive 6-3 ruling striking down the Trump administration's sweeping tariffs under the International Emergency Economic Powers Act, IEEPA. It was a major, unexpected blow to a core pillar of the current economic policy. Now, you have to understand how high-frequency trading, HFT algorithms, process a headline like this. For the last year, these tariffs have been a massive driver of the inflation narrative and industrial supply chain fears. The bots are coded with a simple binary logic. Tariffs equal inflation, removing tariffs equals deflation. So the exact millisecond the Supreme Court decision hit the Bloomberg terminals, the machines triggered a massive coordinated dump of paper silver contracts. It was a violent knee-jerk reaction, a textbook algorithmic slam. They pushed the spot price off a cliff, driving silver all the way down to $79.80. For a few terrifying minutes, it looked like the bullish momentum was broken. It looked like the banks had finally regained control of the tape and successfully painted the chart red heading into the weekend. But what happened next will be studied in trading psychology courses for decades. It was a bear trap of epic proportions. Because while the algorithms were blindly selling the deflationary headline, the actual human beings, the sovereign wealth funds, the industrial buyers, the physical whales, looked at the broader geopolitical reality of World War III brewing in the Middle East and laughed at the discount. The dip was bought. And I don't mean it was bought casually, it was bought ferociously. The buying pressure from the physical market was so intense, so immediate, that it overwhelmed the paper algorithms. Silver executed a violent U-turn, completely erasing the algorithmic slam and ripping straight upward. It didn't just recover the losses, it went nuclear. It blasted straight through the $84 mark. That is a massive $4 plus swing from the absolute lows, all happening within a single chaotic trading session. Think about the psychology of the short sellers right now. They thought they had the perfect catalyst. They thought the SCOTUS ruling was their get-out-of-jail-free card. They likely added to their short positions on the way down, expecting a complete capitulation from the retail crowd. Instead, they are now trapped at the bottom of a $4 reversal. They are burning. Every single entity that shorted silver at $79, $80 is now facing catastrophic margin calls at $84. Euro. And when those margin calls trigger next week, they only have one choice. They have to buy to cover. This creates a mechanical feedback loop of buying pressure that has nothing to do with fundamentals and everything to do with survival. This is exactly why a continuation move back up to the $90 level is now highly likely. The fuel for the next leg up isn't just organic demand, it is the forced liquidation of these trapped shorts. But the pain for the Western banks is just getting started. Because while they are fighting this algorithmic war in New York and London, a massive, insatiable army of buyers is about to wake up in the East. We need to talk about what happens on Monday morning. We need to talk about the China effect and the end of the Lunar New Year. The banks are bleeding today, but if they think Friday was bad, they have absolutely no idea what is waiting for them when the sun comes up on Monday morning. Because the geopolitical panic over the Middle East is only half of the equation. The other half is a mathematical certainty that has been quietly building while the West was distracted by the news cycle. We need to talk about the China effect. We need to talk about the fact that the timing of this global crisis could not possibly be worse for the Western banking cartel. For the last week, the Western markets have been operating in a vacuum. China, the undisputed whale of the physical silver market, has been offline. The Shanghai Gold Exchange and the Shanghai Futures Exchange have been closed for the Lunar New Year holidays. The dragon has been sleeping. And the Western banks tried to use that week of low liquidity to smash the price, hoping to trigger stop losses and clear out the retail speculators before the East woke up. That was the holiday smash they attempted with the Supreme Court ruling we just discussed. But they failed. Silver reversed. And now the holiday is over. Next week, the Chinese markets reopen. And when those traders, industrial procurement managers, and sovereign wealth directors return to their desks, they are going to look at the global board and realize that the game has completely changed. They are going to see that the U.S. is on the brink of a kinetic war in the Middle East. They are going to see that global shipping lanes are under threat. And they are going to look at the price of silver sitting in the mid-80s and view it not as expensive, but as the absolute bargain of the century. You have to understand their agenda. China is not buying silver to trade it. They are not buying paper contracts to flip them for a fiat profit. They are buying it because their entire national strategy depends on it. They are the manufacturing hub of the green energy revolution. They produce the overwhelming majority of the world's solar panels and electric vehicles, both of which require massive, irreplaceable quantities of physical silver. But it goes beyond solar panels. In a world that is rapidly descending into militarized blocks, silver is a highly critical strategic asset for weapons manufacturing. You cannot build advanced missile guidance systems, radar arrays, or satellite communications without ultra-pure silver. When a country like China sees a war brewing in the Persian Gulf, they do not sell their strategic reserves. They hoard them, and they aggressively buy whatever is left on the open market. So, when the bell rings in Shanghai next week, they're coming back with full force. They are going to bid for every single physical ounce they can get their hands on. They are going to drain the remaining inventories out of London and New York. They will happily pay a premium because they know that securing the physical metal is a matter of national survival. This is the China effect. It is a wall of price-insensitive demand hitting a market that has virtually zero available supply. And this brings us to the ultimate nightmare scenario for the COMEX. As the Chinese buying pressure surges next week, we are simultaneously hurtling toward the end of the month delivery window in New York. We have discussed the COMEX math before. We know that the registered inventory, the metal that is actually available to settle futures contracts, has been systematically drained to historic lows. The ratio of paper claims to physical ounces is at a breaking point. The banks have been writing infinite paper promises, assuming that nobody would ever actually ask for the heavy metal. But now, infinite paper is colliding with finite metal. If the geopolitical panic drives the price higher and the Chinese demand sucks the remaining physical float out of the system, the COMEX is going to face a mathematical impossibility. When the delivery notices are issued at the end of the month, the entities holding those long contracts are not going to roll them over. They are not going to take a cash settlement voluntarily. They're going to say, "Give me my silver." And the banks simply do not have it. This is the ticking time bomb of a COMEX default. If the exchange cannot source the physical metal to satisfy the contracts, they will be forced to enact emergency protocols. They will be forced to declare forced cash settlements, effectively terminating the contracts without delivering the underlying asset. Do you understand what happens to the price of physical silver the moment the world's largest commodities exchange admits it does not have the metal? The paper market loses all credibility instantly. The price completely decouples. The paper ticker might say $90, but the real-world physical price will go to $150, $200, or $300 overnight. Because in a world where the exchange defaults, the only way to get silver is to find someone holding a physical bar and pay them whatever they ask. The banks are staring down the barrel of this reality. They are trapped between a geopolitical war in the Middle East and a financial war with the East. They are running out of time, and they are running out of metal. And while the foundation of their system is cracking, they are doing what failing empires always do. They are turning to propaganda. We need to talk about the distraction campaign playing out on mainstream television right now. We need to talk about the Bank of England and the ultimate psychological operation. Part 5. Mainstream Optics. Sky News at the BOE. While the algorithmic trading bots are blowing up in New York, and while the naval commanders are positioning their strike groups in the Persian Gulf, there is another war being fought entirely on your television screen. This is the war for your mind. It is the war of public perception. Because the people who run the global financial system know that the math is breaking. They know the COMEX is facing a catastrophic delivery squeeze next week, and they know that a geopolitical shock could instantly vaporize the purchasing power of their fiat currencies. So what do? When the foundation is crumbling, they paint the house. We need to talk about the massive public relations campaign that the establishment just rolled out, right in the middle of this WW3 weekend panic. If you turned on mainstream financial television yesterday, you didn't see deep coverage of the COMEX silver drain. You didn't see a mathematical breakdown of the trapped shorts. Instead, you saw Sky News. You saw their economics editor, Ed Conway, being granted exclusive rare access to walk through the subterranean vaults of the Bank of England. Think about the sheer theatricality of this broadcast. They stripped the reporters of their phones. They guided them through a maze of bomb-proof steel doors and voice-activated locks deep beneath the streets of London. And then, the cameras flipped on, revealing Vault 4, a glittering, perfectly stacked cavern holding thousands of 400-ounce gold bars. They boasted to the public that there is over 64 billion pounds worth of gold sitting in that single room, and over 5,000 tons in the total complex. They showed the reporter struggling to lift a heavy 13-kilogram gold bar. They show the historical curiosities, bars salvaged from shipwrecks, bars stamped with the Soviet hammer and sickle. It makes for great television. It looks incredibly impressive. But if you understand how central banking works, your alarm bells should be ringing at a deafening volume. This is classic textbook psychological warfare. It is a psyop. You have to ask yourself, why now? The Bank of England is notoriously secretive. They do not just invite television crews into the second largest gold vault on planet Earth for fun. They despise transparency. So why, on the exact same weekend that gold goes vertical to $5,100 and silver reverses a $4 slam? Why, exactly when the fiat system faces an existential geopolitical threat, do they suddenly want to show you the gold? Because they are terrified. There's an old rule in banking. A healthy bank never has to prove it has the money. It is only when there is a quiet run on the bank, when the insiders know the vaults are emptying, that the bank manager goes down to the vault, stacks all the remaining cash in the front window, and invites the local newspaper to take a picture. They are parading these TV cameras through the Bank of England to project an illusion of stability. They want the average citizen to look at those shiny, perfectly arranged bars in London and think, the system is safe. The authorities are in control. The central banks have plenty of gold, so there's no reason for me to panic or buy my own. They are using the visual weight of the Bank of England's gold to distract you from the terrifying reality of the COMEX silver. They want you staring at Vault 4 in London so you don't look at the registered inventory collapsing in New York. And here's the darkest irony of the entire Sky News broadcast. Most of that gold doesn't even belong to Britain. As the Bank of England governor himself admitted, the UK sold off half its gold reserves decades ago at the absolute bottom of the market. The vast majority of the 5,000 tons sitting under Threadneedle Street belongs to foreign central banks, sovereign wealth funds, and international institutions. It is eligible metal. It is parked there for safekeeping. Just like the COMEX, they are flashing someone else's wealth to make themselves look solvent. Do not fall for the theater. When the establishment media suddenly goes out of their way to show you how secure the system is, it is the ultimate contrarian indicator that the system is about to break. They are building a psychological firewall because they know the physical firewall is already breached. They know what is coming on Monday. They know what China is going to do, and they know they cannot stop it. We need to wrap this up. We need to give you the final battle plan for what happens when the markets open and the holiday smash officially dies. So here is the verdict. We have just lived through one of the most volatile, psychologically exhausting, and historically significant weeks in the modern financial era. We watched the banking cartel throw the absolute kitchen sink at the precious metals market. They used algorithmic manipulation, they weaponized a Supreme Court ruling to trigger a massive paper sell-off, and they deployed their friends in the mainstream media to parade TV cameras through the Bank of England in a desperate attempt to project an illusion of stability. But it wasn't enough, because you cannot spoof a geopolitical crisis. You cannot tamp down the reality of carrier strike groups positioning in the Persian Gulf. The threat of a kinetic conflict in the Middle East, a conflict that directly threatens global energy supplies and risks dragging in nuclear superpowers, has completely shattered the bank's grip on the paper price. When you are staring down the barrel of an Archduke Ferdinand moment, the rules of finance change instantly. When missiles are flying and the global supply chain is freezing, you do not hold paper derivatives. You do not hold unbacked fiat currency printed by a government that is about to finance a multi-trillion-dollar war. You hold physical weight. You hold the atoms that have survived every war, every depression, and every empire collapse in the history of human civilization. The smart money knows this, which is exactly why gold violently reclaimed $500 and silver executed a massive $4 reversal to rip through $84. And the nightmare for the shorts is only just beginning. Because on Monday morning, the ultimate catalyst arrives. China wakes up. The Lunar New Year holiday officially ends, and the most aggressive, price-insensitive buyer of physical silver on the planet returns to the trading desk. When the East looks at the escalating war and their own critical need for industrial and military-grade silver, they are going to bid for whatever physical metal is left in the Western vaults. The holiday smash was the bank's last, desperate attempt to shake you out of your position before the East returned and the COMEX delivery deadline hit. It has officially, spectacularly failed. The shorts are trapped in a burning building, and the exits are locked. This is not the time to day trade. This is not the time to play games with leverage or try to time the dips. This is the time to secure your physical position, turn off the mainstream noise, and let the mathematical reality of the shortage do the work for you. The illusion is fading. The physical era has arrived. Hold your mettle. Weather the storm.